Investors Chronicle.
Welcome to the Companies and Markets Show, the podcast that gives you expert analysis on all the latest market and listed company news. I'm your host, Dan Jones, and this is what you need to know. Hello, everyone. It is somehow still January, and this week we are going to kick things off with the big story of the moment. That's DeepSeek, the Chinese artificial intelligence model that has sent a shiver through Silicon Valley in recent days, as its AI capabilities, seemingly built at a fraction of the cost of the likes of OpenAI's ChatGPT, make themselves known. We'll discuss the implications for Nvidia and others with Julian Hoffman and Mike Fahy shortly. After that, we look at a company that needs no introduction. Mike will run us through his cover feature all about Tesco and how the supermarket conquered the UK, how its shares have the edge on rivals, and what we can expect next. To wrap things up, we will look at investment platform AJ Bell, which reported some rather unusual things in its first quarter update earlier this week. Julian and Val Cipriani will be here to look at that. There's no doubt, though, as I say, about the big story of the moment. DeepSeek, a name none of us were really very familiar with until a few days ago, even though it's been around for a few weeks now. It's been a bit of a slow burner, I think. It started to worry the market, I think, over the weekend and therefore certainly on Monday when markets opened in the US. Mike, what can you tell us about the backdrop to this, the context to this, and why people, or certainly tech investors, have become a little concerned?
Yeah, well, you say the app has only been around for a few weeks. The company's only been around since 2023. It was created by a Chinese hedge fund, High Flyer. And the thing that really spooked markets is the fact that it supposedly created this AI model for $6 million when the likes of Microsoft and Meta and others have been pouring billions into their models and buying as many Nvidia chips as they possibly can.
Yeah, it's clearly perhaps reset some assumptions about what you need to do to grow AI or to make AI a huge thing in future. As you say, they've been pouring billions upon billions into Nvidia chips and into growing their capabilities. The basis of that thinking has very much been, in order to advance the technology, we need to pile more and more and more money into it. Very much a SoftBank kind of way of thinking, and SoftBank are involved now with OpenAI as well, and with this Stargate project in the US.
Yep.
The DeepSeek model suggests that actually, as trite and as obvious as this may sound in retrospect, you can work smarter rather than just piling more and more money in on top of it. You can actually refine the algorithms and do it for a far cheaper amount. And therefore, there are various implications for the likes of Nvidia and others, which we'll get on to. Julian, I'll just bring you in maybe with your thoughts on sort of the initial news here.
Oh yeah, I mean, it's undoubtedly sent shockwaves through the sector. I mean, the key point here is that DeepSeek has worked out how to train its model using older Nvidia chips, so basically a much cheaper way of bringing the machine learning model up to speed. The question really is whether it is actually as cheap as they say it is. So there is some disagreement over whether the $6 million figure, which is what's been quoted, versus the average $100 billion that it costs to do a US AI model, is actually real. It may be closer to 500 million, which is not, in the grand scheme of things, is not cheap, but it's certainly far cheaper than anything that the industry in the US can do at the moment. It just definitely feels like an inflection point. Although if you try and use the app at the moment, it's so busy that it doesn't seem to be working at all. So it might be ChatGPT has got one thing over it at the moment, in that you can at least get a query back from it. But the implications are really quite far-reaching. If this kind of bargain basement way of training a model actually works, if you just take the amount of equipment that in the US over the past 3 or 4 quarters has been purchased in order to set up data centers, to set up the servers that you need, that has a measurable impact on GDP. I was reading somewhere like 0.2% of US GDP is somehow of growth, sorry, is tied up with AI modeling equipment. Just the basic servers and chips. And if this new way of doing it comes through and establishes itself, and people start realizing that perhaps the kind of building everything out of gold or gold-plated equipment isn't necessary, then that could have a major downstream impact on a lot of parts of the supply chain. So yes, this is why Nvidia was hit so badly on the trading day. It seems to have stabilized since then, but it's what we don't quite know is whether that every cat dead bounces at least once, or whether people have taken a more sober opinion of it. But we'll see. Actually, we'll only know and as the story develops. And I mean, certainly only in the early stages now.
Yeah, absolutely. I mean, there is a lot of uncertainty. I think I was floating that 500 million figure before we recorded. I can't recall where I saw it now, but I definitely saw something suggesting that actually the model itself might be quite cheap. There's certainly been money put into DeepSeek in the months gone by, but it's all a little bit vague. It's all very new at this stage.
I was going to say, Arthur Sants, our technology correspondent, has written quite a bit about amount of spend that tech companies are making, and the questions more recently that investors have had about the potential returns. I mean, Microsoft is supposedly spending 80 billion in its current fiscal year. Meta's spending about 65 billion. And clearly the implication is that a lot of that money could possibly be wasted if DeepSeek is able to generate similar sort of results as cheaply as it is. But the other question is around how DeepSeek has done what it's done. There's been skepticism from some of the investment banks, and indeed OpenAI yesterday in an article with the FT was suggesting that there's been some distillation of their model, i.e. it's largely been stolen.
Which is a bit rich, given the basis for all these AI systems is to scrape the internet to a greater or lesser extent, or it certainly feels that way sometimes. The share price reactions are interesting, aren't they? As you said, Julian, there was a bit of a recovery for Nvidia after falling, I think, 16%. It was then up 8%. It was down 5% again yesterday. So most of those losses are still there. The data centers, the companies providing the energy for that, the likes of Constellation Energy, etc., were hit particularly hard as well, on the basis that if you require less computing power to produce good AI models, their business model, or what it's been ranked on in the past couple of years, is somewhat different. An interesting one was Meta, though, because Meta has been investing, as they reaffirmed yesterday in their own figures, billions upon billions, hundreds of billions, I think Mark Zuckerberg was saying, in AI, in buying these chips from Nvidia. Their share price hasn't really, it's gone up rather than down. It's quite interesting to look at that, really. I don't know if the market thinks that this is just money they could write off, almost as they kind of did with the metaverse, although it does seem with all that metaverse spending, they just moved it into AI. But it does seem to be the market is taking a bit of a more positive view on Meta. So that's one to watch for now. We'll see how that shakes out, of course. Julian, I wanted to ask you what you think. It's a tough question for anyone. What you think might happen next? Because there is this paradox that's been floated around by all the tech CEOs this week, the Jevons paradox, saying that, AI becomes more efficient, but the fact that it becomes more efficient and cheap means that consumption of it will rise. So we're not worried about this fact that people are doing it much more efficiently than we are currently, which, while it may be a fair point, doesn't necessarily mean that the winners early on are going to be the winners overall. So does it all boil down to the fact that, as you said just now, we are still in the very early days of AI, and this is a reminder of that?
There's a kind of parallel here with how people used to talk about the early internet, like it would be this great democratizing force in our lives, and that everybody would be able to take part in it, and and that ultimately would drive users. And people tend to talk about AI in the same way, but I mean, fundamentally, we don't know yet what it's capable of doing in a practical sense, and whether that capability is going to translate necessarily into profitability. That's the other uncertainty it shares with this time in about 1997 with the early internet. I think what will happen basically is people will work out whether the cheaper model can work as well or as efficiently as ChatGPT can, or Meta's own model, and they'll make their own conclusions on that based on that. And fundamentally, it's quite an interesting point. If a lot of people can get into this space at a relatively low investment, with a relatively low investment, it's going to heat up competition hugely. I would say you might even say that the dominance of the big seven in this area could come to an end, which I think in some ways is quite an exciting development from a market point of view. But the negative for investors is whether they've now vastly overpaid for a whole range of tech and data companies.
The jury is still out on that, isn't it? I mean, there's been a reaction this week, but not a severe reaction in the context, it might be fair to say. So people are still keeping a watching brief for now. I think that is a good point, though, about the ability of people to use these AIs, or if AI is much cheaper than we think it's going to be. Certainly the optimistic take from a economic context for those who think that AI will be a huge productivity gain is that people will be able to make those productivity gains much more cheaply than they would. So while it may be bad for the providers, it could be very good for those seeking to use it, whether it's software companies using it for coding or what have you, people using it for all kinds of different aspects. So that's certainly something to watch. And your point about the internet as well reminds me, as we've seen some reference this week, to what happened to the telecoms companies, where people thought at the advent of the internet age that they would be the ones making all the money from it, providing all the infrastructure. It didn't turn out that way, as we quickly found out 20 or so years ago.
They got stuffed on infrastructure as well, if you recall. I mean, it was like they buried all those fiber optics, and about 80% of it still isn't in use.
Indeed,
all these years later. So there is an infrastructure risk to the shares, which I don't think people realised before.
Yeah, certainly. We are not at that level yet. It's fair to say that we are not viewing the tech stocks as telecoms utilities at this stage. It's still, as we keep emphasizing, in the early stage. But it's certainly, if not a reality check, then a good reminder of how things may not play out as people were certainly thinking in the past year or so. We're going to turn now, though, to our cover feature this week. As I said at the top, it's a company that needs little introduction. It's the supermarket Tesco. Mike, why don't you tell us your thinking behind the piece, put it in a bit of context for us, and then we can get into the meat of the thing.
Nobody does need any introduction to Tesco. It's everywhere, on every high street. It takes about a quarter of grocery spend in the UK. But in terms of looking at it in more depth, over the last couple of years, we've looked at a few of the US technology giants. We've looked at Unilever as a staple, but we've never really kind of dug into the supermarket sector. This is one way of looking at it, and especially because there are now only really two main listed supermarkets in the UK, in Tesco and Sainsbury's.
It's an interesting time to look at it as well, isn't it?
Yeah.
I mean, clearly we've come off the back of this period of huge inflation, huge food price inflation. So not everyone's going to be very happy with the supermarkets right now, certainly if they're not shareholders and certainly if they're just shoppers. But as we've talked about maybe ad nauseum on this show before, the supermarket margins are quite narrow, certainly compared with the food suppliers with whom they're sometimes in dispute, the likes of Unilever and others. But let's talk about Tesco maybe in the context of its rivals, its market share, because as you might expect, there have been a fair few ups and downs over the years, albeit it's now sitting quite pretty at the top again.
Yeah, so one of the interesting things when I started to look into the history, and I don't want to cover too much of the ancient history, but Looking at its market share, it was second to Sainsbury's for an awfully long time, for decades. It was considered very much the kind of down at heel second fiddle as well. There's a book called The Making of Tesco, which is based on a bunch of oral history that Tesco execs had done, and is in the vault somewhere within Tesco. And there are interesting snippets in that. There's a bit from David Malpass, who was CEO in the 90s, talking about when he started. Tesco was almost like a shameful place to work that he didn't want to tell his friends about. But it's pretty much 30 years to almost to the day, really, when Tesco both launched Clubcard and then overtook Sainsbury's in terms of the market share. At the time, March 1995, it overtook, and at the time they were both on a market share of about 19%. Since then, Tesco has kind of really, it's been unassailable. Its market share rose to, I think it peaked in 2007 at almost 32%, and although it's the discounters, the Aldis and Lidls of this world have eaten into that since, it's still very high. I mean, its market share for the 12 weeks running up to the Christmas period it was at 28.5%. Sainsbury's was second at 16%, severely lagging. And even though Tesco and Sainsbury's have both, in more recent times, pulled away from the rest of them, particularly because Asda and Morrison's have entered into private equity ownership at a time when interest rates were rising and they had more debts to pay.
Let's talk a bit about Clubcard, because it has been a big driver of their success. Certainly, it seems in recent times, since the launch of Clubcard prices, which I might moan about from a personal point of view in a minute, but I mean, the number of people, certainly the number of households who are signed up, is incredibly high across the UK, and obviously that gives them a big bank of information to work with, which they have worked with for many years now as well.
Yeah, it's something like 28 million households in the UK and 23 million have a Clubcard. It is pretty omnipotent. And within Tesco, I think they can attribute more than 80% of the purchases to a Clubcard holder. There are very few holdouts now. I mean, when it first started, within the first year, they got up to 8 million. So they made some pretty impressive gains. But I think it was really prices under Dave Lewis's watch where the company directly linked discounts only to Clubcard members, where it really started to take off. And as you've said, people find that really annoying. A lot of people, I think, maybe became reluctant Clubcard holders, but they are now Clubcard holders and they do use it regularly and they do get the points, etc., from it. The idea behind it, Terry Leahy, another ex-chief exec in the 90s, was credited with it, really. He was on, before he'd been at Tesco, he was at the Co-op on a management training scheme there, and the Co-op had the reward it pays to members, the share of the profits. And the idea from Tesco was very much just that. It's a thank you for shopping with us. There was quite a lot of debate about how much they should give, and 1% didn't seem like a great incentive, but it was something that customers appreciated. But the key with it, and the reason why it's been so useful to Tesco, is that it was linking the card holder and their spending patterns. So from that, it developed a real kind of in-depth knowledge of who was shopping where and what they were buying.
Yeah, the Clubcard prices. I'm going to do my little
Yeah, go
complaint
for it.
now. I am one of the reluctant households, or we are. I say it's definitely reluctant. I'm barely even in the scheme still now. I still go in there, and because prices have risen so much in recent years, and there's the two-tier system, you just think sometimes, I feel like for some people as well, they might get tricked if they don't have a Clubcard, and they'll go and end up paying a huge amount. But the CMA, for example, say I don't really have, can't really have any proper complaints, because some people thought, oh, maybe they're hiking the non-Clubcard prices, but the investigation found that wasn't the case.
Well, the fact that they launched an investigation shows how the perception, at least, of the fact that this was being used unfairly, and that maybe non-Clubcard, so the prices that aren't in the deals that are available to Clubcard members were inflated, whether it was temporarily or whatever. And even within the the CMA's investigation. It investigated, I think, 5 or 6 of the main supermarkets. And although it found, I think it said 92% of the deals were genuine and were a real saving, there was still a perception, like over half still thought that somehow there were some inflation of prices around it. So it shows that maybe some users are reluctant users, but still, at this stage, it seems to have managed to have captured enough.
Indeed. And it's definitely a trailblazer insofar as almost everyone has some kind of reward scheme now, despite the skepticism
Yeah.
to begin with.
What Tesco found was that there was reluctance in terms of the anonymization of the data, and they do kind of anonymize it so they know from spending patterns which the type of customer who is spending uh, and what they're spending on in which stores, and it could use that to compare, say, two similar types of stores, and if meat sales, say, were dramatically lower in one, it allowed them to quickly identify problems and fix it. Similarly, if a Sainsbury's or a Waitrose or whoever opened a store nearby and it started to lose sales, before it had this data available to it, it would pretty much have to do blanket advertisements and then blanket coupons, and a lot of that would be wasted because there would be people who had no intention, either had no intention of ever becoming a Tesco customer, but who went in and used the vouchers, or people who were already committed Tesco customers who would also use the vouchers. Whereas with the club card data, it allows them to target the people, or certainly the types of people, the groups of people who it felt it had lost.
Let's talk a bit about the investment case, because
Yeah.
it's hard with a brand like this to separate it sometimes from the points I've just been raising, the day-to-day experiences we have. But from an investment side of things, certainly the share price has been pretty good in the past couple of years. But as part of the piece, as you might expect, given it's from us, we do dig down into the investment case and what makes it different from some of its rivals in terms of some of the key metrics that you would look for at supermarkets. Clearly, as we have already said on this show and say regularly, they are low margin businesses,
Mm.
but there are ways to be very profitable within that.
Yeah. So, I mean, low margins are low margins, but the way you compensate through that is high volume, high turnover. You know, the Jack Cohen's own motto: "Pilot high, sell it cheap." So we looked at the DuPont model, which is a model that financial analysts use to break down returns on equity, because the net margins of the supermarkets are all really low, and we worked off net margins just so that there's a fair like for like, because we put Asda and Morrison's in there and Aldi as well. So, and if you're comparing a privately owned company with a PLC, there are going to be differences in terms of the cost of funding and other things that will affect. But from a net margin perspective, Tesco was slightly ahead of the others, not massively, but slightly ahead. And from that is the building block from which you then see, with that rapid turnover, how it develops into a much stronger return on equity. And Tesco's return on equity was about 15%.
I think we say, well,
Yeah.
the figures we have are, around 15%.
Yeah, and you compare that with Sainsbury's was really low last year. There was a reason for that, which was last year it took a bunch of impairments on its bank in preparation for selling it off. But I was looking at a Morgan Stanley note recently, which takes adjusted figures, and even with adjusted figures, Tesco's is 80 basis points higher than Sainsbury's. Tesco's is about 4.4%, Sainsbury's 3.6%. And over the longer term, it's led into far superior returns. And we put a chart in the piece looking at the compound returns over 30 years, and the chart looks pretty spectacular, really. Sainsbury's has only really been pretty average. It's had a compound annual growth return of 2.5%, whereas over that 30-year period, Tesco's is closer to 8%.
You can now get 12 weeks of an Investor's Chronicle print and digital subscription for just £12. You'll get instant access to our website and our app, plus the magazine delivered to your door every week. Check the terms and conditions in the show notes for more information. And what about the future? To refer back to the past immediately,
Yeah,
they've had the expansion plans is what I'm talking about here, and
yeah.
that brings to mind some of the failed overseas expansion that they had that caught them out a few years ago. But what are they looking to do in future to keep growing?
Yeah, it's funny because at the start of this period when Club Card was introduced, Tesco was pretty much a grocer and it only really had operations based in the UK and Ireland. It then used that data to go off and do all kinds of things, expansion in Asia, very costly failure in terms of expanding into the US, but also a big branch out into non-food. Some of that has been more successful than others. Obviously, it's got the bank business it's just sold off, but it still has a reasonable mobile business in terms of services, and clothing has been decent as well. But there were other things like at one stage there was a branded electronics range which was a disaster. And it's funny that towards 30 years later, when we're looking at the business now, it really is back to being that core grocery business. And although it has a couple of operations in Eastern Europe still, it's in 3 countries in Eastern Europe. The focus is largely UK and Ireland. So if you look at international expansion largely being off the table and that they've rolled back in some of the other areas like banking, you'd start to question where the growth is coming from. And I did ask analysts about this because to sustain the type of returns that it offers, it clearly needs growth. And there are a couple of interesting areas. One is marketplace. A few years ago, it had a Tesco direct business where people, it's ordering over the internet. It's trying to compete with Amazon, and that was closed. That was another area of expansion that proved costly and unworkable in the end. But with marketplace, it's doing it differently. It's using the Amazon marketplace model, if you like, matching buyers with sellers. It's not carrying the stock itself. It is just either delivering or allowing people to pick up in stores. And one of the others that Sainsbury's and lots of other supermarket chains are doing now is the retail media side. And this is another area where Clubcard gives it a big advantage because of the data it has on customers. It allows advertisers to tailor their advertisements to individual stores where sales might be higher. People can get personalized recommendations on the app, and the value to the company trying to make use of the retail media is much greater because of the distinction in that. But the value to Tesco and to the other supermarkets doing this is huge. Retail media margins are about 60% compared with anywhere between 2 and 5 for grocery retail.
So a lot of potential there.
Yep.
That is our cover story this week. As I say, do check that out. If we've whetted your appetite, there's a lot more in there. To conclude, though, we're going to talk about AJ Bell, the investment platform. Julian, why don't you kick us off? Because clearly this is a company that for the past couple of years has really done very well out of higher interest rates, not least the money it earns on client cash, which we might come to in a minute. But the Q1 trading update out on Wednesday this week showed some interesting figures in another context, perhaps, in terms of the discrepancy perhaps between the D2C side of the platform and the advised business. What did you make of the figures?
AJ Bell, obviously the last man standing when it comes to platforms that are listed on a stock exchange. So it's an interesting company in the sense I think it's now getting more scrutiny. So the shares on the day of the trading update were flat when investors started looking closely at the mix of its revenue coming in and how net flows were happening in different parts of the business. So AJ Bell is kind of unique among the big platforms in that it gets a lot of money or referrals through what it calls its advised channel. So this is advisors out in the Shire, as it were, directing pension holders, maybe retail investors, perhaps people who aren't particularly savvy about their own investments, but are happy to leave it to advisors. He gets a lot of net inflow from that particular channel, and it's important for Najable because that's quite lucrative if you can get those kind of pension transfers, those kind of advised transfers in. What the market noticed was that the amount of advised net flows was lower than many had expected. So it got about 1.4 billion in that channel, whereas the market had been predicting about 1.6. So there was a kind of slight suggestion that the final quarter of the year, which kind of coincided with that rather awkward budget period, was a bit ropey for AJ Bell, which is perhaps just a quarterly aberration, and certainly the company seems to say, I think, that behavior will, or investor behavior will now return to normal this year. But there was definitely a slowing down in the amount of inflows that were coming in that final quarter, which has kind of left the questions over its performance this year in the air. But as you say, it's a lot of it is based on interest rate income as well, whether cuts by the Bank of England are going to impact the net interest income that they earn on client accounts, which in AJ Bell's case is quite substantial. But it wasn't a terrible update. I mean, I don't think there's no way that we can give that impression, but there was definitely a few question marks over it. And AJ Bell has always thrived on the fact that its business has been much more solid and clearer than, say, Hargreaves Lansdown. Hargreaves was forever reorganizing itself by comparison, and AJ Bell was very, very focused. So it's the first time I think I can remember that there are a certain amount of wariness coming into the story of it.
Yeah, the client cash, RBC, I think, estimate a third of revenue comes from that currently. So if rates do fall more than we expect this year, if the economy does deteriorate more than people currently think, that's certainly something to watch. I think AJ Bell has said in the past they should be insulated for various reasons, but the proof will be in the pudding. I just want to bring in Val at this point to talk about a couple of the points made in the update about the pension flows, because as Julian was just saying, on the advised side, they said in the run-up to the budget, as they said at the Q4 stage, that they saw some outflows from the advised channel due to budget concerns. At the same time, they said they saw greater inflows in the D2C, the private investor channel, ahead of the budget. So it seems either we've got two different cohorts acting in diametrically opposed ways, or maybe there's more to it than that. Clearly, before the budget, there were concerns about the lump sum, or there were rumors that the government might change lump sum rules, which may have prompted people to act in one way. But what are your thoughts?
Yeah, it's quite interesting and surprising to an extent that there would be such difference. So I think here the issue is, before the budget, obviously there were a lot of rumors about different topics. One of them, as you were saying, was that the tax-free lump sum on pensions might be cut. And there were definitely, like, I've spoken to various advisors who told me that they had advised clients, not to be rushed, because obviously if you take out your lump sum, that you can't put it back in, you've got this big lump sum of money that then is potentially subject to various taxes if you can't, if you don't need it. Basically, just leaving it there in a savings account is not a great idea generally. So advisors, I think quite a lot of them must have said something like that to their clients, but a few of them have told me that their clients were just very concerned and decided to take out the lump sum anyway. So that was definitely a trend. On the other hand, one of the other things that is always discussed before budgets and came up this time as well is pensions tax relief, whether it could be cut in some way. And so it appears that especially maybe some of the retail platforms, people sort of rushed to, contribute to their pensions. Maybe they were going to do it anyway before the end of the tax year, and they did it ahead of the budget instead. So, for example, at the time, another platform, Best Invest, said that they saw a tenfold increase in pension contributions in September 2024 compared to the same month the year before. So, it's definitely like there was a lot of stuff going on, but it is quite hard to tell why there would be such a difference between the advice side and the sort of retail side, because the rumors, obviously, that were being circulated to an extent were the same. So you wouldn't expect that wide a difference. So, it might be just like AJ Bell using it a bit to explain why the inflows in the advice side were lower than expected. There are some other speculations we can make. in terms of, advisors obviously follow closely what is going on. They might have mentioned it to their clients, so they might have had, people who were more cautious with what could potentially happen in the budget and react a bit more quickly. And then I was also thinking perhaps it's possible that retail platforms have slightly younger clients, so they may not necessarily, even be able to take out the lump sum because they're not at that stage yet.
It might be a case that a little information is a dangerous thing. Sometimes these advisors follow news more closely, you would imagine, than some private investors, or certainly they follow rumors, we should say, and maybe they were taken in by the rumors and the speculation a bit more, and that may have led to some unwise decisions or unwise suggestions to clients. But we are now speculating ourselves, so we can't deliberate too much on that. It is interesting, though, to see that in the context as well of some decent flows from others. St James's Place, Quilter, Quilter and Integrafin both have advisor platforms too. They didn't really see that weakness in Q4, which suggests that if this was a trend, it wasn't that widespread on the advised side, and maybe it's more of an AJ Bell thing, but that will be something to watch in quarters to come. Speaking of which, maybe it's worth considering the impact of Hargreaves Lansdown. As Julian said at the top, or implied, they are soon to be taken private via a takeover deal. There may be some price cuts on the horizon as well, or at least the consortium taking them over has suggested they would need to invest in price, as they say it, to remain competitive. So I wonder if that would be something to keep an eye on too in terms of AJ Bell customer numbers, things like that.
You're right. So the other thing that's on the horizon, I think, is that there might be a platform war in terms of prices. Last year, Hargreaves Lansdown did cut rates for its ISA platform, as well as things like junior and lifetime ISAs. And that's prompted other players with much smaller businesses to do the same. So there is the possibility of a pricing competition coming in, and they're probably couldn't be more welcome, really, especially if you use Hargreaves Lansdown. It's a very bespoke and expensive proposition if you're doing not too much with it. But if Hargreaves does get its act together and really put the brakes on its own margins in order to attract more business, then that is going to have an impact on AJ Bell ultimately. Although AJ Bell seems to run on very small costs, I think it's by comparison. I mean, one of the criticisms of Hargreaves has always been that it's very sort of large and large marketing budget and a lot of people in Bristol. So yes, I mean, the new owners might change that quite quickly.
Yeah, there's certainly some potential there. I think it was the junior ISA where those changes were made, recently. And certainly when you look at the charges for funds, that side of things, Hargreaves has always been on the higher side. So there's potential there. But again, we are back in the realms of speculation. We will see. That, though, does bring us to the end of today's show. We have unfortunately run out of time. So thank you very much to Mike, to Julian, to Val, and to our producer, Maddie Apthorpe. We'll see you next time on another Companies and Markets show.